Hello, ladies and gentlemen. Greg Mikulowski from ForexLive.com. This is a Forex Quick Look. I'm going to take a look at the dollar versus Canada. So let's get started. We saw U.S. PPI data come out a little bit weaker. Of course, we have the FOMC rate decision later this afternoon, and all that's going to come into play in all the major currency pairs. But we are seeing the dollar versus Canada move to the downside and trading here today, all for the weaker data and maybe a little bit higher oil prices today. Oil prices are still below the $70 level at $78.76 currently at the moment. That's up only about 25 cents or so on the day. So it's not running way to the upside, but at least it's not going to the downside. But technically what we have here that sticks out to me is first things first, this low right here, this floor here, I should say. This goes over the last 1, 2, 3, 4, 5, 6, 7 trading days. We have a number of different swing lows through here and here and here and here and here and here. We moved a little bit below it yesterday before rotating back to the upside and then back down, testing that level and trading here today. Finding support buyers on the first look at 135.48-ish type level. In the process of the move to the downside today, we did fall back below the 100-day moving average. In fact, fall back below the 100-hour moving average and fall back below the 200-hour moving average. So these levels now become resistance. Being below all of them is more bearish. But with this floor in play, you still have to respect that from a technical perspective. It held support at all these levels here and found buyers that pushed the price to the upside on each and every one of the occasions. So respecting that floor is key, and having traders put their bid against that level with a stop below is likely what they are doing. So if the price were to break below the 135.48 level, then I would expect to see further momentum selling that could take the price back down to test the 200-day moving average, which, by the way, held support here and here. It tried to hold support here, but broke below that level and then spent a little less than a day trading below the 200-day moving average here on its way to the low price in December at 134.79. So the 200-day moving average would be another key target on the downside on further momentum through the 135.47 level. Now, if the price were to move back above the 200-hour moving average, then all bets are off. It would be another indication that the floor here held again, in which case we look then toward these other levels on the top side, including the 100-hour moving average, 100-day moving average. And finally, up here, this level right through here, defined by the 38.2% retracement and swing levels all through here between the 136.13 and 136.22 is a key ceiling. So if this is a key floor, this is a key ceiling, and you can see why this level was a ceiling at first. Was both a support and resistance through here, and then became a ceiling through here. We moved a little bit above it here, but then failed, and then here. And again, in trading yesterday, the price came up to that area and found resistance to sellers against the level. So as everyone knows, when the price trends to the downside like this, what I like to see is a price move above the 38.2% retracement. And so far, the price has not been able to get above that 38.2% retracement since bottoming here. So getting above that is going to be key going forward, and that's something that you can put away through the FOMC rate decision if we do get the dollar moving higher because of a more hawkish Fed or less dovish Fed. Then getting above the 38.2% retracement would be needed to increase the bullish bias for this pair going forward. So the levels are in play. They're pretty straightforward. We have a nice little floor. We have a nice little ceiling. We are looking for the break and the run. And we're also waiting for the FOMC rate decision. So there you all have it. My name is Greg Mikulowski. Good fortune with your trading. Bye-bye now.